In America, you bought $50,000 of shares years ago. They're now worth $150,000, and today you sell the lot. In America, the taxman is waiting. In the United Kingdom, waiting. In Australia, waiting. In New Zealand, your tax bill on that $100,000 gain is, for most ordinary investors, exactly zero, nothing. This is one of the most generous investment tax settings in the entire developed world, and it's sitting right under our feet. But here's the thing. Most Kiwis either don't know about it, don't believe it, or don't understand the three traps that can quietly take it away from you. So today, I'm going to explain exactly why you don't pay tax when you sell shares in New Zealand, what that's really worth to you over a lifetime, and the three situations where the taxman absolutely does come knocking. Get this right, and it might be the most valuable 10 minutes of your financial life. First, the rule itself. New Zealand has no general capital gains tax. When an asset you own, like a share, goes up in value and you sell it, that gain is treated as capital, and capital gains are simply not taxed here as a general rule. What is taxed is income. So the dividends your shares pay you, those are income, and you pay tax on them like you would on interest or salary. But the growth itself, the difference between what you paid and what you sold for an ordinary long-term investor in New Zealand shares, that belongs entirely to you. Buy shares in a company at $10, watch them climb to $30 over the years, sell them, and the $20 of growth per share is yours, untouched. And this isn't a loophole or a gray area, it's simply how our tax system is built. New Zealand taxes what you earn, not what you own as it grows. Politicians have tried to introduce a capital gains tax here several times over the decades, and every single attempt has failed. It remains one of the defining features of investing in this country. Now let me show you what this is actually worth, because the difference compounds into something enormous. Picture two investors, one in Sydney and one in Auckland, each holding the same diversified fund earning the same returns for 30 years. The Australian pays tax on their capital gains when they sell, the Kiwi doesn't. On a large portfolio built over decades, that single difference can be worth tens of thousands, sometimes hundreds of thousands of dollars, kept instead of paid. And it changes behavior too. It means every dollar of growth you earn is a full dollar that keeps compounding for you, not a dollar that arrives with a deferred tax bill attached. When we've said in other videos that New Zealand quietly rewards people who own assets, this rule is the engine behind it. But, and this is the part most videos skip, the rule has edges. Cross them and your tax-free gains become fully taxable income. There are three traps, and you need to know all three. Trap number one, the intention test. This is the big one. The tax-free treatment applies to investors, people who buy shares to hold them, collect dividends, and grow wealth over time. It does not apply to traders, people who buy shares with the dominant purpose of selling them for a quick profit. And here's the crucial detail. What matters is your intention at the moment you buy. If Inland Revenue looks at your account and sees constant buying and selling, shares held for days or weeks, companies chosen purely because the price might pop, no interest in dividends whatsoever, they can classify your activity as trading, and then every single gain gets taxed as ordinary income, at your marginal rate up to 39%. Inland Revenue's own guidance describes exactly this pattern. Someone rapidly flipping shares picked for short-term price movement with no records showing any other purpose. So the practical advice is simple. Be what the rule protects, a genuine long-term investor. Buy quality, diversified investments, hold them for years, and keep basic records of your buys and sells. The line isn't about a magic number of trades, it's about purpose, and your behavior is the evidence of your purpose. Trap number two, foreign shares and the $50,000 line. This one catches thousands of Kiwis, especially anyone buying American shares on investing apps. New Zealand's tax-free treatment fully covers New Zealand shares, and it also covers most Australian shares listed on the ASX. But shares in companies from the rest of the world, the United States, Europe, Asia, fall under a completely different regime called the Foreign Investment Fund Rules, the FIF rules. Here's how it works. If the total cost of all your foreign shares stays under 50,000 New Zealand dollars, you're fine. You're taxed just like a local investor, dividends only. But the moment you cross 50,000, and that's measured by what you paid, not what they're worth, the FIF rules capture your entire foreign portfolio, and you're taxed on a deemed income of 5% of the portfolio's value every single year, whether your shares actually went up, sideways, or even down. Yes, you read that right. Under FIF, you can owe tax in a year your portfolio lost money. Let me make it concrete. Say you've invested $60,000 into American shares. You're now over the line, so the FIF rules apply to all of it. If the portfolio's worth $60,000 at the start of the tax year, you're deemed to have earned 5%. $3,000, and you pay tax on that at your marginal rate, roughly $1,000 for someone on the 33% rate, even if your shares finish the year flat or down. Now compare that to a friend who kept $45,000 in US shares and put the rest into New Zealand shares. They stay under the threshold, and their tax on those foreign shares is just the dividends. Same kind of investments, wildly different tax outcome, purely because of where one line sits. And it's $50,000 per person, so a couple investing jointly gets $100,000 between them. One piece of good news on the horizon, the government has proposed doubling that threshold to $100,000 per person. But as I record this, that's a proposal, not yet law, so plan around the 50. The simple takeaway, keep your directly held foreign shares under the threshold, or use funds that handle it for you, which brings us neatly to the smart structure in a moment. If this is saving you from a nasty surprise, take a second and hit the like button. It genuinely helps more Kiwis find the channel. Trap number 3, property is playing a different game. Don't confuse the share rules with the property rules. Your own family home, tax-free when you sell, as we've covered before. But investment property has its own tripwire, the bright line test, which taxes the gain on a residential investment property sold within 2 years of buying it. And property flippers, people buying and renovating to sell, are taxed as traders no matter how long they hold. The clean way to think about it, the intention test applies everywhere: shares, property, even crypto. Buy anything with the main purpose of flipping it, and the gain is taxable income. Buy assets to genuinely hold and grow, and New Zealand largely leaves you alone. So how do you actually structure things to keep it all clean and tax-free? 3 simple moves. First, for your long-term investing, favor New Zealand and Australian shares held directly or diversified funds and genuinely hold them. Second, if you want global exposure beyond $50,000, and you should want global diversification, use a PI fund, a portfolio investment entity. The fund handles all the FIF calculations internally, and as a bonus, your tax on the fund's income is capped at 28%, even if your personal rate is 33 or 39. Your KiwiSaver already works exactly this way, which is one reason it's such an efficient wealth machine. And third, keep records, your purchase confirmations, your costs in New Zealand dollars, and hold on to them, because our system is self-assessed, and years later the burden of proof sits with you. One last honest note before we wrap up. Tax rules are written by politicians, and politicians change. A capital gains tax gets debated in this country every few years, and there are always proposals floating around. Nothing lasts forever, and nothing in this video is personal tax advice. For your own situation, talk to a qualified accountant. But as things stand today, the setting is what it is, and it's extraordinary by world standards. So let's bring it all together. In New Zealand, an ordinary long-term investor pays no tax on the gains when they sell their shares. Not on New Zealand shares, not on most Australian shares, and not on a modest foreign portfolio either. Over an investing lifetime, that single rule can be worth a six-figure sum compared to the same investor in Sydney, London, or New York. The three traps to respect: don't behave like a trader because intention is everything. Watch the $50,000 foreign share line or let a pie fund handle it. And remember, property runs on different rules. Do those three things, invest patiently, and this country will let your wealth compound in a way almost nowhere else on earth does. That's not a loophole, that's the system, working exactly as designed, for you. If this video just saved you money or opened your eyes, do me a favor and hit like, subscribe if you're not already, turn on notifications, and I'll see you in the next one.